The market is falling, and I've been buying the dip across the board. But over the past week, there's one company that stands out that I've been buying more than SoFi, more than BMNR, more than anything else. And that, of course, is Nebius. They just reported earnings this week. The stock is down about 30% in spite of fantastic results. They just signed a deal with Meta in addition to their Microsoft deal, which they announced last month. In this video, I want to talk about the valuation. I want to talk about the results and the stock price action, talk about the technical analysis and the critiques, and even share some of the bear cases that I'm seeing around Nebius so far and why it's grown to become the second largest position in my portfolio. This is going to be a fun video, so let's jump right in. I don't talk about Nebius very often, and it's actually very interesting because I want to start covering it more on my channel. This was, of course, a company that I started buying in the $50 range. I continued buying all the way up. I was buying above $100, and I'm sure as heck buying right now when it's under $100. Just for context to set the stage, Nebius is down about 29% here in the past week alone. It's trading at $86.50. And of course, it's down about 33% in the past month. But if you look in the past 3 months or year to date, it tells a very different story. So we peaked on Nebius at around 140 bucks, and then we fell all the way back down to 86.50. And it also fell on the back of earnings, despite delivering some pretty good results. Now, I want to cover just very quickly the spark notes of the earnings, and then I want to go to some posts that talk about it a little bit more in depth. So here you have an annualized run rate revenue for the end of 2026 of $7 to $9 billion. Now, this is an amazing expectation for annualized run rate. Of course, how they calculate this is by taking the revenue from the last month of the quarter and multiplying it by 12, which is not the most accurate way, but it is a significant expansion of what they were expecting previously. I think previously this number was closer to 5 billion, and now they've gone and almost doubled that number at the high end of the range. They're also guiding for significantly increased capacity of over 2.5 gigawatts, up from 1 gigawatt, which is absolutely staggering to see just the sheer rate of growth that this company is guiding for. The connected power here that's fully provisioned and can be activated upon GPU installation is 800 megawatts to 1 gigawatt, up from 220 megawatts here. They're sold out of all of their capacity. They are running at 19% adjusted EBITDA margin. The adjusted EBITDA at this stage of the company is definitely a positive thing to see. Now, the revenue is 355% year over year, 39% quarter over quarter. The core AI infrastructure business grew at 400% year over year and 40% quarter over quarter. They have $4.3 billion in convertible notes in an equity offering that they raised in September. They just partnered with Meta and Microsoft, and they also have Cursor as a customer, which is really interesting because Cursor was in the news today. They also talked about the Nebius token factory. They talked about their AI cloud. And of course, Nebius has stakes in all of these other companies. And all of them have really interesting roadmaps and are growing at a good, healthy pace. They mentioned that they sold out of available capacity in Q3. They say they're fully on track with the execution of the Microsoft contract and expect revenue from the deal to start ramping up throughout 2026. Meta deal was $3 billion over a 5-year term. In fact, the demand for capacity was so overwhelming that the size of the contract was limited to the amount of capacity we had available. In other words, Meta would have bought more, but we just didn't have the capacity to fulfill the demand for somebody like Meta. So really here, they're very supply constrained as they continue to aggressively ramp up. The entire year, they've had capacity issues as they've been scaling. They can't scale fast enough. They say here, we'll continue to aggressively ramp up capacity to be able to support these large deals, as well as to serve our core customers, startups, and enterprises alike. And that's why they're raising more money so that they can grow faster in accelerating their investments in infrastructure, power, land, and GPUs. They also highlight here we'll be putting in place an at-the-market equity program for up to 25 million Class A shares on November 12th, 2025, yesterday. So this is about 10% dilution here. And again, they mentioned that this is in order for them to be able to scale faster so that they can meet more of this demand. They also mentioned that most of this was already booked for 2026, but let me dive a little bit deeper because I'm getting ahead of myself. I mentioned that I wanted to make a Nebius video with all of this analysis that I've been saving in my feed. So let's get started. I saw this from StockTwits. Nebius is number 2 in trending slots. This was yesterday. The stock is down more than 8%, but sentiment is extremely bullish. So there's a massive disconnect in terms of what the sentiment is and what the actual stock price is showing. Here's Elijah saying, hey, the earnings are staggering. They sold out of all current capacity and half of 2026 capacity. NVIDIA Blackwell is coming online soon. Of course, dilution is part of the story, but you're missing the forest for the trees as to why they need that capital in order to scale faster. Here you have one of the co-founders at Nebius. He's saying Q3 results in short, we sold out all we had. We're building much more. And I think that was a nice way of summing it up. Very, very concise way. I think I retweeted this post. This was Daniel who said Nebius's rule of 40 is 719, which is off the charts level of growth because, of course, the rule of 40 calculates the growth percentage as well as the profit, the EBITDA. The chief revenue officer also mentioned on the call that more than half of the 7 to 9 billion ARR target by the end of 2026 is already booked. So if I try to phrase that differently, I would say they already have 4 to 5 billion in ARR already booked for 2026, and they're guiding for 7 to 9, which is kind of crazy. Because again, the moral of the story here is they're massively supply constrained in order to meet this overwhelming demand. The CEO is explaining Nebius's 3 phases. Phase 1, secure land and power. They mentioned that this was 1% of capital expenditures, the land and the power costs. Build data centers, about 20% of the costs, and deploy GPUs, of course, is the lion's share of the cost, about 80%. Quote, we secure as much capacity as we can, build as much as capital allows, and only fill GPUs when demand is visible. So I think this is an important point to highlight is this quote, they only fill GPUs when the demand is visible. So when we're looking at all of their facilities and how fast they're scaling, know that there's always a guaranteed customer on the other side of that deal, because if they didn't have the contracts in hand, they wouldn't even be scaling. And they mentioned on the earnings call with regards to the Israel data center that they basically have sold out before it's even operational, which further reinforces that, they want to secure as much capacity as possible. They want to build as much as possible, and they want to capture as much of that demand as they can possibly can in the fastest way possible. They mentioned that the demand is going to be there all throughout 2026, and they don't see the demand subsiding until at least 2027. So for 2026, it's really going to be more supply constraints as a result of the massive demand that there is in the market. And I mean, look at these customers. You have Meta and Microsoft as hyperscalers partnering with them. You have Cursor. And this one's actually really interesting because Cursor just earlier today released that they're raising more money at a $29.3 billion valuation, which is nearly 12 times the value that the company had just back in January, less than a full year ago. So Cursor is absolutely killing it, and Cursor is a customer for Nebius. What happens when Cursor continues to scale? They continue to have demand. All of that is going to come into Nebius's way, right? So, okay, we've established that this is a company that is massively supply constrained, and this company is trying to grow as fast as they possibly can in order to meet that supply constraint. One of the things that people didn't like was the dilution aspect. They're diluting 10%, and people are saying, well, they're never going to stop diluting. They're going to continue to grow through further dilution. But I think for as long as the demand is there, they can always outpace that dilution with their growth rate. I mean, 300%, 400% growth rate. If they continue to meet all of that demand and increasing the guidance in the way that they have over the course of 2025, then I think you're going to be in a very healthy spot, regardless of that dilution, because they're doing it with 19% EBITDA margin as well, right? So that's one thing to keep in mind, especially if management expects the demand to continue at least for the course of 2026. And especially if a lot of these new facilities are basically sold out before they even become operational. So now that brings me to my next point, which is to talk about valuation, because the stock has taken a dip. It's fallen 30% in the past week alone. Here, Michael says he's sticking with the 160 price target for Nebius by early 2027. It's not going to be a smooth ride, but essentially they're scaling massively with insane growth, and paying 7 times forward sales is a steal. And this was back 2 days ago. So you're actually paying less now because Nebius has continued to fall over these past 2 days. Here's Daniel again, amazing resource to follow on Nebius, highlighting the assumptions around their growth expectations. And as a result of those assumptions, highlighting the bear base and bull case. Now you're going to see some crazy share prices here. And I think even if we hit the bear case that Daniel highlights here, $360, like that's over a 3x by the end of 2026. I don't really think that these prices are going to hit. This is actually staggering for these prices to hit, but I can see how he can get here because he's extrapolating out these massive triple digit growth rates that Nebius is putting up. And I think one of the reasons why Daniel is so insanely bullish on Nebius is because of the guidance, the 8 billion midpoint for the ARR until the end of the year. And that's compared to a $25 billion market cap. And that doesn't even account for the subsidiary value for what they own as well. If you account for that growth rate on top of their core business growth rate, then the numbers become even better. Here you had a little recap of the earnings. This user says that the dilution aspect is the only reason it's not up in the short term, and that investors are basically not loving the fact that they're being diluted. The 25 million share dilution, 2.7 billion that was filed yesterday will of course affect the short-term price, but overall the company fundamentals remain very strong and the company will continue to grow. Here's Mitchell saying the risk reward is not where it was at $20, but obviously, we have a much more clear picture around what is 26 going to look like and can they sustain these growth rates. And I think management assuaged a lot of fears on the earnings call with regards to the demand. They have the earnings call up on YouTube, so you can even just go and listen to the Q&As by analysts, and you'll see what I mean. Management provided a lot of color on what they see for the market in 26 and what they see for that demand moving forward. Here you have Daniel saying, why did Nebius go down despite good earnings? After the Microsoft deal, we saw a big jump in ARR guidance that was already priced in. The market was expecting a hyperscaler deal for a new multi-hundred megawatt data center in the US, not just the 50 megawatt in Finland. The whole data center space is down because the market is starting to feel unsure about the long-term profitability. Partly it's that which is specific to this sector, but I think partly the market is just going more risk off, and you're seeing high beta names across multiple industries sell off across the board. So that's why I'm not too concerned. I'm relying on the fact that these fundamentals will continue through 2026 and that this growth rate will continue through 2026. Here you have Nick doing some projections. 2025 revenue was 500 to 550 million, 90% from core infrastructure, up 400%. Management guided 7 to 9 billion in ARR, and he's taking the low end of that ARR guidance and he's basically comparing it to the market cap, saying, hey, look, this is a 2-year forward price to earnings of 19 and a 1-year forward peg of 0.19, which is very, very low from a valuation perspective. Here you have this user saying Nebius reported a quarter with adjusted EBITDA margin of 19%. That means that if Nebius doesn't grow its EBITDA margin or revenue at all, its EBITDA would still be nearly 2 billion, implying a 2027 EV to EBITDA of just 15 to 20, assuming the same 19% margin. With revenue expected to 10x next year and a worst case 2027 EV to EBITDA of 15 to 20x, Nebius still looks deeply undervalued. So I think you start to get the trend. Again, this user Serenity saying 24 billion market cap, doing 8 billion forward ARR, targeting 30% EBITDA margins, which is materially higher than the 19% that they just reported. Nebius core business powers the Mag 7 hyperscalers, Microsoft and Meta, to Shopify, to Cursor, to Accenture, and government AI infrastructure. They have over 10 billion NAV with hypergrowth portfolio companies powering Cloudflare, TikTok, Tesla, Netflix, Anthropic, some of the biggest companies in the world, most established brands. Of course, they're growing 700% year over year, which is almost unheard of, going from $125 million quarterly to 2 billion plus in just a single year. The company is at the center of the AI build out and set to be the next $100 billion plus company. Do not let the broad sell-off affect your conviction. And of course, there's some people that are going to sell on this news, but I think there's a lot to be bullish about. Again, we're basing all of it on the back of the growth continuing. And this is the last post I'll share on valuation. This is Mark Hogan saying the new rough ARR-based valuation and 12-month price target. At 12x $8 billion ARR, we get $96 billion valuation. That's materially higher than what they are right now. Consider cash and subsidiaries, 1.68 billion plus 1 billion raised via new shares, plus 2.75 billion raised with convertible bonds equals $5.4 billion in cash, plus the subsidiary value is 12.1 billion. This is a capex intensive business, so to be more conservative here, I'll simply assign zero value for all the cash and all the subsidiaries and treat all 12.1 billion to be future capex. The total value, 96 billion, would equate to roughly $215 per share. And then when accounting for future share dilution, Mark came up with $322 per share. Of course, a massive upside from here. It's like a more than triple from here. Analysts are raising their price target after earnings. So here you have DA Davidson maintaining their buy rating with $150 price target. Here you had a price target raised to $211 from 206 at Northland Securities, flying over 100% upside from current levels. That's actually very bullish. I don't understand why they would only raise it by $5, like how that backs into their model, because the ARR assumptions were materially higher than what they've posted in the past. So I don't understand how that equates to $5. But having 100% upside from an analyst perspective is quite bullish because analysts don't really want to put their neck out on the line. The $205 price target from Northland is off the assumption of $2 to $4 billion in ARR value. Now, if we use the same economics, we would get $355 per share off of their 7 to 9 billion ARR that's projected. And keep in mind, over half of this is already booked for 2026. So when you look at Northland's own math, you get a share price that's materially higher than $211, their $5 raise. But I guess, I mean, a raise is better than no raise at all. So I'll take it. $211 is still very, very bullish. Here you had Manuel saying, keep in mind that institutional ownership in Nebius remains relatively low. That's what I think will drive the next leg up. Option selling with Christian said it absolutely will after earnings. This has been my favorite catalyst since the beginning, buying Nebius in 20s and 30s. Institutional ownership and new coverage on the name is increasing. This is the first time we even made the Earnings Whisper weekly earnings list. A lot of analysts still think we're Yandex. Quite crazy to see this company growing so quickly and have such little coverage overall. And you're going to see the coverage increasing as well, not only because you're playing in the AI space. Michael Burry keeps yelling AI bubble, yet both CoreWeave, which is much more well-known brand, and Nebius sold out of their H100s and pre-sold Blackwells before the data centers even opened. So this is the example I was talking about that they mentioned on the earnings call. Two of the biggest AI clouds can't even keep GPUs in stock. That's not a bubble, that's a compute famine. So again, Ben here is talking about the demand that is very, very prevalent, which makes this company supply constrained, which basically guarantees the growth for 2026. Now, why did I say a lot of people are going to take notice to Nebius? Well, you're going to have them added to the MSCI equity index on November 24th. So they're going to be added to yet another index. Now, I said CoreWeave is the most well-known brand. That's because CoreWeave is a US company, and of course, Nebius is a Dutch company. Some of the critiques, here you have Austin saying major issues with Nebius is, of course, dilution, which kills shareholder value. And this is across the board for everything that you hold. The more slices of the pie, the thinner your slice is going to be. That's basically dilution in a nutshell. They missed the short-term revenue guidance, so why should we have confidence in 2027 guidance? And then Austin says, I'm not really sure how this company becomes profitable at this point, even though they're putting up 19% EBITDA margins and they're guiding for 30% EBITDA margins. So the EBITDA margins are going to expand even. Here you see the 25 million Class A shares at the money offering, $2.5 billion, which they just did yesterday, accounting for 10% dilution. That, of course, is one of the biggest bear cases. Here you have another post saying when the Nebius CEO says only 1% of the data center is capital expenditures, what he means is 80 to 90% of Nebius data centers are leased. So it will not show in CapEx, but cost of revenue. So again, there was this whole debate around the land and power. But one thing to keep in mind is, again, they don't commission anything until they have the contract, until they know that the demand is there. So I think it's going to be safe from that perspective. Here you have another post saying Nebius is servicing hyperscalers over smaller companies. This does not seem optimal to me. Hyperscalers will come and go. Smaller companies will stay and recur. The saying no to customers is a great place to be due to demand, but the no should be to Meta and not other companies. Yeah, so what I'll say to this critique is that they're partnering with Cursor just as much as they're partnering with Meta. And I think the Metas and the Microsofts of the world are also good because it gives them a staying power from a brand perspective that the biggest companies in the world are working with Nebius. And that is great advertising, great marketing for their product and for their reputation. Here you had Austin saying, I strongly recommend you stop giving ARR guidance until most of your revenue is actually recurring. Right now, you define ARR as the revenue in the last month multiplied by 12. You have some deals being paid partially upfront, which creates lumpiness in your ARR. A much better metric is using the trailing 12-month revenue and then guiding to the next 12-month revenue. Would make it easier to model the company and probably make institutions more interested. So this critique, I absolutely agree with. I think that ARR is going to be tricky as the business continues to scale. Now, two resources that I found really helpful in making this video that I suggest you guys take a read is Wealthy Readings Substack here, detailed review around Nebius's Q3 earnings. One other resource that I think is fantastic is Manuel's Substack. Manuel has been in Nebius since like $25. I mean, I read the earnings report. I also listened to the earnings call, but after reading Manuel's Substack, I think it definitely made me more bullish. So he talks about gross margins. He talks about the ARR. He talks about the demand. He talks about the supply constraints. He talks about the dilution and the guidance, and he gives new numbers for his valuation model as well. So that's also a great resource. Now, let's very quickly cover some of the technical analysis. So you have this massive area here, which is a momentum breaking down. And I hate to say it, but Nebius is filling this gap down here because we've had a sustained drop. This user has been right on Nebius, saying that it's going to fall to the $80 range. And I didn't want to believe it. And it's being proven right as well. I don't know how much further it falls. I wouldn't be surprised if we fell into like the $75 range. Maybe even lower if the market drawdown continues holistically. Doesn't really change my thesis. I mean, I have cash secured puts on Nebius, so it doesn't change my thesis, but I would be careful because technically speaking, from a short-term perspective, the charts don't look fantastic. I will wrap up with a post here from Daniel, which highlights some of the near-term catalysts for Nebius. I thought this list was very well done, so let's go through it. Some near-term catalysts to keep in mind. When algos rotate back into high beta AI names with FOMO building off the $100 support zone, the MSCI inclusion is going to increase the volume for potential Q4 benchmark upgrades and passive inflows. So basically more institutions adding. QT ending December 1st, unlocking $5+ billion in monthly liquidity for CapEx heavy infrastructure plays. Announcing the new greenfield sites, the Toloco announcement, which was hinted, the Data One announcement, any new contracts and partnerships, short squeeze potential with 18% float, short and borrow rates spiking above 25% post earnings, analyst initiations from major banks like Morgan Stanley, Bank of America, and others. ClickHouse IPO within 6 months, valuing Nebius 28% stake at over $4 billion based on 350 million ARR with a 45x multiple. This one's going to be a big one. NASDAQ 100 inclusion decision in December, acquiring $30+ billion in market cap by November and driving $1 billion in inflows and 65 to 80% institutional ownership. EU AI initiative funding grant announcement in January 2026. The 13F releases from big tech and other institutions, which are due tomorrow on November 14th. Analyst re-rating and more coverage. Interest rate cuts if it happens in December. And government shutdown ending, which happened just yesterday. Lots to look out for. A lot of that is macro, but a lot of it is specific hints from the company around new announcements and new releases. Overall, for Nebius's earnings, I don't like the dilution just as much as the next guy, but I understand why they're doing it. I think it's going to help them grow much faster. And really, with high growth companies, the thing that I'm hesitant about is sustaining that growth. Of course, we know Nebius is going to have tough comparable periods down the line, but it seems as though for 2026, that growth is going to be sustainable, considering more than half of it is already booked and they're selling out before they even open these facilities. And it's also evident in the fact that their deals with hyperscalers are limited to the capacity that they can provide. Because Nebius is sold out of all available capacity, they're having to say no to a lot of these customers until they can build much faster, which is obviously not great, but it's also better than not having enough demand to grow as fast. So I think the business is going to do fine. The fundamentals, I think, look great. And I'll summarize with a quote by the CEO in the earnings report saying, quote, 2025 has been a building year as we put in place the infrastructure and framework for future rapid growth. This year, We believe that we have successfully laid the foundations for an outstanding 2026, a year that should firmly position us among the top AI cloud businesses globally. And at the same time, 2026 is still just the beginning. He's mentioned that in the past, that this is just the beginning. This is early innings. We're just getting started in our ramp up. It's evident in their astonishing growth rates. It's also evident in the fact that they're so incredibly supply constrained. So I think good things to look forward to for this one. It's of course my second largest position as of this recording. And honestly, after everything that I've seen and in preparation for making this video, I couldn't be more bullish around Nebius. Please let me know where I'm wrong. I don't want to be blindly bullish on any company. I don't love the dilution, but I understand it. And if you enjoyed this Nebius video and you want me to continue making more Nebius videos, please let me know that in the comments below. Thank you so much for watching, and I'll see you in the next one.